Fatima is a 28-year-old graphic designer in Edmonton. She graduated 4 years ago and has filed her taxes every spring since. Same job, same income, same everything. Last April, she sat down at her laptop, entered her T4, and watched her refund calculate to $570. She stared at the number. Last year, it had been $2,100. She had not changed jobs. She had not gotten a raise large enough to explain it. She assumed she had made a mistake. She had not made a mistake. Something had simply run out, and nobody had ever told her it would. Here is what most Canadian graduates do not know about their tuition tax credits. When you pay tuition at a qualifying post-secondary institution, the Canada Revenue Agency allows you to claim a non-refundable federal tax credit equal to 15% of eligible tuition fees. For a student paying $8,000 a year in tuition across 4 years, that is $32,000 in eligible fees and $4,800 in federal credits that accumulate on Schedule 11 of your tax return. The credits do not expire. They carry forward indefinitely. And in Fatima's early post-graduation years, when her income was modest and her actual tax owing was small, those credits absorbed her entire federal tax bill and produced a healthy refund every spring. Most people assume that is just how taxes work for graduates. What they do not realize is that the credits are being drawn down. Every year, the carry-forward balance on Schedule 11 decreases by the amount applied against that year's tax. The balance is finite. It was always finite. And the spring it hits zero, the refund drops permanently to whatever it would be without those credits at all. Here is where Fatima's first instinct was wrong in an interesting way. She assumed the problem was her income, that a pay raise had pushed her into a higher bracket and increased her tax. The math actually pointed the other direction. A higher income would have generated more tax, but also more credits applied, and the net effect on refund would have been smaller than what she experienced. What actually happened was the opposite. Her income had stayed flat, her tax had stayed flat, but the carry-forward balance that had been absorbing that tax had finally hit zero. The cushion was gone. Not because anything changed in her life, because the credits she earned in university had been fully used up. Here is what to do. Step 1. Log in to CRA My Account and open your most recent notice of assessment. Scroll to the federal tuition, education, and textbook amounts carried forward. That number is your remaining balance, the exact amount left on Schedule 11. If it is zero, or close to it, your refund will not recover without other changes to your income or deductions. Step 2. If you have a lower income year coming, a career change, parental leave, a sabbatical, consider whether accelerating deductions or RRSP contributions in that year make sense. Step 3. If you are still in school or recently graduated and have a higher income spouse or partner, know that unused tuition credits can be transferred, up to $5,000 federally, to a spouse, parent, or grandparent in the same tax year they were earned. Once you carry them forward yourself, that transfer option is gone permanently. The credits Fatima earned do not disappear. They were fully used. They did exactly what they were designed to do. The refund drop was not a mistake. It was the end of a benefit she never saw running out. Knowing your Schedule 11 balance before it hits zero is the difference between being surprised and being prepared.